All right. So, welcome back. All right. So, this is going to be chapter 5, which is going to be where the calculations are going to actually come more into play here. Chapters 1 through 4 was more conceptual based. It was just learning, but just about how the rules and guidelines actually work for how to properly journalize and properly do accounting. So this is where we're actually going to actually apply those concepts and understand how to do it by looking at the very first section of merchandising type of business activity, right? Is to what happens when we need to purchase inventory, okay? So here we are, okay? So let's talk about merchandising inventory. So because we are in the process of just learning how to just set up a store, like a retail store, to sell a product to consumers, this is what you need to understand, right? Sorry, excuse me. Okay. So this is what you have to understand when we're looking at merchandising inventory, is that our goal is to purchase these inventories, right? Okay, so what we're doing is we're buying the inventory. We're converting cash into goods, right? And then we're going to take those goods, right? Make it, a little personal. And we're going to convert those goods into sales. And once we do that, then sales becomes cash. So our main purpose and goal here is to buy at a low price and turn around and sell it at a higher profit. Okay? So with that being said, right, we need to understand how we purchase our inventory in the first place by making those purchases of inventory, right? What are the necessary things that are included in order to purchase our goods and then turn around and convert them into sales, okay? So again, once again, what kind of store are we looking at? We're looking at more for retail stores, so any type of, store that sells a product or service, so mom and pop shops, clothing stores, really small stores. And then, of course, we're also looking at wholesale stores too, because wholesalers, right, they sell products, but they just sell it in bulk to the public, okay? So then, here we go. We're going to talk about merchandising inventory and what is actually going to be included in the cost of purchasing the actual item, okay? So the definition here is when we look at the cost of inventory, it's going to be every single cost it takes to get the asset to your store, okay? So once again, it's all cost it takes to get the asset to the store, okay? So that means that can include, right, the cost of goods sold will include things like the original selling price, okay? Sales tax if there's any freight expenses or shipping cost, okay? If it's a fragile item, they may require you to pay for shipping and handling. For any reason that you buy inventory in bulk, you might need to have them as storage fees. That's all going to be included as part of inventory, okay? Now, in most cases, if you are a retail store or a small business, you can be exempt from sales tax, okay? You can be exempt from sales tax. However, right, it really depends on who you purchase from, especially from the vendor, if they allow small businesses that purchase from them to get a tax exemption or not, okay? Now, oftentimes too, if you actually just go to the actual physical store and purchase it, you can be subject to sales tax. So sales tax can be included as part of the cost of goods sold, but most times, most cases, if you are a retail store, you can be tax exempt for because your goal is to turn around and resell it out to the public. Okay, so that sales tax is going to get collected somehow. Okay, so that is going to be what's going to be considered the cost of goods sold. Okay, so all of these expenses are going to be tacked on to actually purchasing the items and inventory. Okay, so let's talk about how shipping and how freight works. Okay, so there are two types of freight. You have FOB, which is freight on board. Okay, so this is when a company has its own, what do you call it? Delivery services. Okay, and they require, or not require, but they charge you the shipping and freight cost together with they actually bill you together in one bill. Okay, where at COD can be if a small business or another wholesaler, right? They actually have a third-party vendor, all right, deliver the products to the store, okay? And usually, oftentimes, you're going to see that they would bill you separately because it's a third-party vendor. And we call that cash on delivery, okay? So these two types of delivery services, yes, they do exist. Some of them are more I believe FOB is more widely used because COD, yes, it can happen, especially like UPS or FedEx. Usually they require either like a signature or validation. They may charge the company to charge you the shipping, right? Or this could be if you go actual to the physical FedEx or UPS store, you're going to have to pay that cost separately, okay? Now, in this case, right, how this works. So when we understand ownership of inventory, right, we have to understand that the purpose of making sure that you understand how the ownership of the asset or the inventory item that you're planning to purchase and sell, how that works is that we have two sections, which is called FOB shipping point and FOB destination, okay? Now, this is going to determine who is responsible to pay for this section of freight. So, if you did not know, freight is a two-way street, okay? Especially when you're shipping products from one location to another, okay? It's a two-way street. So in this case, right, when you purchase your inventory assets, right, you purchase them right now, it's currently considered FOB shipping point, where it's making it from the seller's store and making it its way to the midpoint, okay? And that, in this case, right, you, as the buyer, is responsible to pay from the shipping from the seller's store to the midpoint, okay? You are responsible to make sure that you pay the shipping just to get from the seller's store to the midway point, okay? Once it leaves the midway point and makes it to your store, right, the seller is responsible for paying the shipping from the midpoint all the way to the buyer's store, okay? So great example would be Amazon, right? Oftentimes when you order something, right, you pay for shipping right then and there, right? Because you're paying to get from the seller's store to the midway point. But once it gets to that midway point and it's slowly starting to make it to your house, who is responsible for if that package doesn't get to your house? Right? Amazon is, right? And that's just the crazy thing about that. And then if you never receive your package, what do? You call the store and say, or you call Amazon, you say, I never received my package. And what they'll do for you is they'll either give you a refund or they will replace and ship you out a new package, okay? So that's the best way to understand it, is that this is how we understand how shipping works, who is responsible to pay, and who is responsible if it never makes it to the store. So in this case, right, we've already paid to get the product from the seller store to the midway point. But as soon as it leaves that midway point and it reaches to the destination, right, hence the word FOB, destination, which is your store, if you received it, then, you know, the job is done. But if you did not receive it, then it is the seller's responsibility, that who shipped out the product should have paid for it, and also is going to pay for it if you never received it, okay? So this is also how ownership moves from seller to buyer, right? It leaves the seller's point and it leaves the seller's store and makes it to the midway point. So now the ownership is being transferred over from seller to buyer. As soon as it gets to the store, right? Once it gets to your store, it is your property, okay? But it's still the property of the seller if it's still being traveled from their store to the actual buyer's store. Right? Any questions around here?
No.
Okay.
No.
Okay. So now let's talk about the inventory tracking methods. So there is two types of methods that we keep track of inventory. In this case, it's going to be periodic and perpetual inventory, okay? So what this essentially means is, so we're going to, in this class, we're going to take a look at both methods of periodic and perpetual, okay? For this test, we're only going to look at the first one, which is going to be periodic inventory. When we come back from the exam, that's where we're going to compare and contrast the difference between periodic and perpetual. However, I do need you guys to know the difference between the two methods because I will be talking about them. All right? So there are two different methods. Now, when you are looking at inventory, right, you can have a periodic inventory and you can also have a perpetual inventory. In this case, you can have both. However, if you choose one item to be periodic, you must use periodic all the way. If you are, and then same thing with perpetual, right? So in this case, it depends on the item that you sell. That will be determining on how you are going to keep track of them, okay? Now, what's the difference between the two? Periodic, okay? Literally, the definition of periodic means every once in a while, right? It's, you check on it every so often, right? It's occasionally, okay? It's not like you do it all the time, right? You look at it periodically, every once in a while, or in this case, you do it every occasionally, okay? Now, how we understand periodic inventory is when you are purchasing inventory, right? The main goal is you don't care to keep track of it as often as you would for a product that you don't very much sell often, okay? So in this case, right, what happens is that usually for periodic inventory, you don't actually know how much is left until you reach the end of a given accounting period, right, which could be daily, weekly, or monthly, and you take a physical check or a physical count of your inventory, okay? And this happens at the end of a given period, okay? You don't have to do it every day, right? But you can do it every day. I know that most stores, like especially clothing stores, they usually have inventory count at the end of the day. But in this case, right, it's depending on how you operate your business and especially the products that you sell, right? So your end of the giving accounting period could be at the end of the week, at the end of the month, right? So here's the key factor here. You must take a physical count because at the end of the day, you're not keeping track of it during or when you actually sell the product. You don't care to keep track of it. So in this case, that is periodic inventory. And in this case, right, all purchases and sales, okay, are recorded, but the actual amount of inventory is actually going to be determined at the end of the accounting period when you take a physical count. Okay, and here is, okay, so now that's periodic. So let's talk about perpetual. Perpetual, the definition of perpetual is constantly, right? Where you're constantly updating your inventory. Okay, so that means every time you make a purchase, you're updating your inventory. Every time you sell the product, you're updating your inventory. So in this case, right, when we determine the difference between periodic and perpetual, perpetual is when you are selling a product that you more frequently sell often in your store, and that's something where you should be keeping track of whether you have enough on hand at all times, and that's perpetual. Okay, so whether you do a physical count every day, every week, or at the end of the month, you're going to know at least a rough estimate of how much you should have on hand. So this is a good example, right, in store, right? Oftentimes, a lot of products that you sell in the store, they have barcodes, right? You scan those barcodes, you'd be able to do an inventory lookup to be able to see how many quantity you have on hand and in the back of the, warehouse, whatever you have, right? So that's what a perpetual inventory does, is that you're keeping a tight track of how many items you have on hand at all times. Okay? In this case, right, here's going to be another key difference between periodic and perpetual, right? Under periodic inventory, since we don't care to keep track of it as much as or as often as much as we'd like, right, because of the product that we're selling, right, doesn't necessarily mean we have to keep track of it all the time. We're going to refer the inventory every time we purchase it. It's going to be an expense to the company, all right? And then at the end of the accounting period, you're going to have what's called a conversion entry, where you convert your expense into inventory as an asset, okay? So once again, you're going to recognize your inventory as an expense first, and then at the end of the given accounting period, you will convert the expense into inventory, okay? Where periodic inventory, right? Since you have to keep track of it and keep a close count of it, you're going to automatically place it into inventory automatically. When you purchase it, it's automatically considered an inventory asset. And everything, when you sell it, you're going to take it directly out from inventory. Okay? So that's the huge, huge, huge difference here. One is an expense to the company. The other one is a pure inventory asset. When you buy it, it becomes an asset immediately. Okay? But for today, right, we're going to only focus on chapter 5, which is going to be surrounding periodic inventory. Okay? So we're only focusing on this first half, and then when we come back from the exam, we will learn the second half. Okay? So let's talk about periodic inventory. Okay? So here's your first example, okay? That on July 1st, XYZ company, right, purchases 100 units of toys from Toys R U, okay? Toys U. Okay? And each toy costs you $5.65 each. Okay? And freight costs gave you a total of $100. Okay? Purchase was also made on an account. Okay? So what does that mean if it's on an account? Okay? And so let's go ahead and practice to record this transaction. Okay? So for this case, right, when we talk about the cost of the asset, in this class, as we looked at the example earlier, right, there's many factors of what you have to include as part of the cost of inventory, okay, or part of the cost of goods sold. In this class, I'm only going to test you on 2 ideas, okay, and that's going to be purchase expense and freight expense, okay? So purchase expense is going to be more so along the lines of what the actual purchase of the product was, okay? So the actual purchase of the product. How much did it cost you to buy the product, okay? And then the other one's going to be a freight expense, which is going to be a separate cost. Even though it's part of the cost of inventory, we're going to treat it as a separate cost that the company has to pay for shipping and handling, okay? So freight could be more a sense of understanding like shipping and handling, but shipping and handling could also mean if you have fragile items, right? You have to pay a little extra to keep the products a little safe as it goes through the shipping process. So we have 2 things that we're going to be focusing on. Okay? So with this example here, right? Now, if we remember, right, purchase expense, right? It's an expense account. When we understand expenses, right, how are normally expenses increased?
With a debit.
They're good. Now
yeah.
that's correct. They are normally increased with a debit. So I have 2 expenses, right? I have a purchase expense and a freight expense. So if I already know that I'm acquiring inventory, right? I'm buying inventory, right? But because I'm doing periodic inventory, I'm treating it as if it's an expense to the company. So because I'm incurring an expense, right, I'm debiting my accounts, right? And plus I put it on an account, which is a liability. So in this aspect, right, we're going to treat that as if it's going to be a credit because I owe money because I'm not paying it right away. But in this case, right, when we talk about purchase expense is going to be what you actually purchase the inventory items for. So in this case, I purchased 100 toys, right, at $5.65 each. So that should give me a grand total of $565, okay? Here it tells me that freight is going to cost me $100, okay? So this, assuming this is FOB. Freight expenses, right, is going to be $100. And then, of course, because I placed it on an account, which is a liability, right, we usually refer that as accounts payable. It's a liability, so it's going to be credited. And here, my journals match, my debits match my credits, right? I have a total of $665 worth of inventory, right, which includes the freight, right, because that's how much I owe. So this is a good example, or here's an example of what to do when you recognize that you're purchasing inventory, right? Any questions here?
No.
All right. And that's it for that section right there, okay? So when we understand purchasing inventory, this is how we do it. We recognize what the purchase is at hand, what the freight expenses are, and make sure they're separate. And depending on how you pay for it, whether you owe it on an account or whether you pay with cash or a credit card, you're going to list it as a credit here, okay? So, of course, when we are buying our inventory, right, we do have the possibility of receiving discounts. So this is where I'm going to introduce you for the first time what terms are, okay? So terms, okay? So this can be applied to both customers and vendors. In this case, we're focusing on purchasing inventory. So we're focusing on just the vendors here, okay? Chapter 6, we'll talk about sales, okay? We'll talk about the customers in Chapter 6. So in this case, right, I'm focusing on what it takes for a vendor to offer me a discount. Now in this case, right, this is what it will look like. It will normally give you a percentage and a number, net a number. Okay, now what does this mean? In context, right? This means that if I pay within 15 days, I can take a 2% discount. But if I do not pay within 15 days, right, I must pay the whole bill in full in 30 days. Okay? Now, in this context, right, there is a condition that needs to be met in order for you to be able to take the discount. And that condition is that you must pay the entire bill off within 15 days. If not, the whole bill is due in 30. Now, again, this is going to be considered a incentive or a tactic, okay, that most companies use in order to get the money as soon as possible, okay? Because there's often times where we will see examples where, we can fault on the payment or a customer can fault on their payment, right? Or not even pay at all. And that's why this is an incentive, because if you can pay the entire bill within a shorter amount of period, right, the vendor will give you a generous discount. Okay, so again, it's an incentive. However, it's also, you have to meet a requirement of paying the whole entire bill within 15 days in order to receive that 2%. If not, the entire bill is usually due in 30 days, okay? Now, the net 30, right, depending on who your vendor is, you can owe, usually you can owe 30, 60, 90 days, depending on what the company is. Again, it just depends on who you're purchasing it from, but usually, companies like QVC, they let you try the product out and for 90 days, and then you can get your money back guarantee, or you have 90 days to pay for the product, right? So that's a great example of, you don't necessarily have to have net 30, but again, terms can fluctuate. You can have 1% for 10 days, or you can have usually, it just depends on what the company offers you, but usually when we look at terms, they can fluctuate on what they are, right? It doesn't have to be necessarily this exact number. Okay? So when we talked about terms, now we actually have to look at purchase discounts. There are two methods that you can use when you are dealing with terms, okay? Because when you are given terms, that means you have the opportunity to take advantage and pay for the product in order to receive the discount. But when we take a look at that, there are two methods of how we can record that if we are given terms, okay? And that's the net method and the gross method, okay? So think of it like your paycheck, right? Your net method, right, is going to be your gross earnings minus out all the taxes, and then you get your net gross pay, right? Where your gross pay is going to be before the taxes. So there's the same concept that applies here too. When we talk about the net method, you're actually going to calculate the discount out of it immediately. Okay? Meaning you're gonna record the amount as if you already paid for it and already discounted the amount out. Okay? Where gross method, right? You're going to record it as is, and when you meet that condition or when you pay, then you recognize that you can take your discount then, okay? So let's go ahead and take a look at the gross method, okay? So gross method, right? Let me go back real quick. Now, the idea between the net and gross method is also going to be how well or how good you are paying off your bills, okay? If you're a huge company, the net method would most likely be more widely used, especially because you have the money to be able to pay it off right then and there. But if you're a small business and you're not quite sure about making your payments or having enough money to even make the payment in the first place, that's where you should be using the gross method. Because in this sense, right, you have other priorities that you have to pay for first, such as rent. Rent is going to be the number one, then utilities, then paying your employees should be your number one priority over paying off for your inventory items, okay? So that's why the gross method would most likely be used for smaller businesses who have other priorities that can't technically afford to pay right then and there, okay? Where net method, right? You would use it for a company who is really good at paying their bills and pay on time and have the money to just instantly just pay it right then and there, right? So now let's go ahead and move into the gross method. So again, the example here is that on February 1st, okay, let's look at the dates, very important. February 1st, you purchase 100 coffee mugs on an account, okay, from Cuppies Co. Okay, and each cup cost you $1.25 each with a freight of $100. So let's go ahead, and terms are 5%, 10 net 30. Record this transaction, okay? So in this case, right, let's practice how to record the gross method, right? Gross method is we're recording it at full price value until when we realize, right, when we do make the payment, then we can go ahead and take the discount if we made the terms. But if we didn't, then we just pay it regular. So in this case, we're going to record it at full price value, okay? So again, purchase expense, right? We bought 100 cups at $1.25 each, right? So 125. Freight cost you $100, and you placed it on an account which was a total of $225, okay? So that's just recording it gross method as of February 1st, okay? So let's take a look at scenario number 1, where let's say, fast forward, it is now February 9th, and you decide to make a payment to Cuppies Co., and you wrote a check to them, okay, for the entire purchase, okay? So in this case, because terms was 5%, 5%, 10, net 30, okay? It is now February 9. Okay, so in this case, did we make the discount period or did we miss the discount period?
You didn't.
You made it, right? Because in this case, you were given 10 days. You only spent 9 days to pay for it. So in this case, you made it. You made the discount period, okay? So now we need to record the discount. Now in this case, because we're using the periodic inventory method and we're looking at expenses, right? When we record our inventory, what we're going to do is we're going to create a contra account, okay? Which we know what a contra means, right? We need to create an account to reduce either the main account or the sub account. In this case, my main account is going to be periodic, purchase expense, right? That's going to be my main account. So in this case, right, because I've already recorded that I already had the inventory item, right, by saying that I purchased something, right? Now this is where we're recording the payment, okay? So the first one was recording that we received the inventory items, right? Because we purchased 100 items, the freight cost me $100. Okay, so this is us recording that we received the inventory and that we owe money, okay? The next one is going to reflect that we're making a payment, okay? So in this case, I'm paying for what I owe, which was for the total amount of $225. However, because I did recognize that that I'm paying within terms, I should receive a 5% discount. Okay, so therefore, I'm going to go ahead and write out a check for less amount because I deserve that 5% discount. Okay, so in this aspect, right, whatever amount that I owe, it's going to stay in my books as whatever amount that I owe until I make a payment. Okay, so in this case, right, I need to recognize that I received a purchase discount, which is going to be for $6.25. Now, in this case, when we talk about taking discounts, you absolutely cannot take a discount off of freight. So you can only discount the purchase expense itself, okay? Now think about it, right? In real world terms, right? Can you go to the post office and say, "Hey, can I get a discount off of shipping this item?" They're going to laugh at you because you can't, because you can't get discounts when you ship items because it's based on weight and it's based on the size of the box as well. All right? So in this case, there's no way you can take a discount off of shipping. It's unfortunately not something you can take a discount for. So in this case, right, I have to take the 5% discount off my purchase price, which is going to be my 100 times $1.25, which is 125, times 5% of that gives you $6.25. That is the only price that you can discount, is just only the actual purchase price of the inventory item itself. Okay? So make sure you keep that rule of thumb there. Same thing. Can you take a discount from sales tax? No. You can definitely never cheat the government and say, "I'm going to discount you for the sales tax." No, it doesn't work that way. Okay. So in this case, we're going to create our contra account, which is purchase discounts, which decreases your purchase expense. Okay. So by doing so, right, saying that, well, I'm going to get a discount off of my purchase, which is going to be for $6.25. And of course, I'm going to write a check for less amount because I got a discount off of the items. So in this case, I'm writing a check for $218.75, where I actually owe in grand total, right, $225. But because I should receive a discount, right, and of course, the vendor's going to recognize that too when they receive your check, right? They're going to recognize that, okay, you owed me $225, but yes, because you paid within terms, I'm going to grant you that discount. So the vendor should be receiving less. And as us, the person who bought the item should be writing a check for less. Okay? But then let's talk about scenario 2. What if instead of February 9, you paid for it, let's say fast forward, it's actually February 15, okay? And you decided to pay Cuppy's Co. for the purchases, okay? Terms, once again, were 5%, 10, net 30, okay? And now we need to be able to record this transaction. Now, in this case, right, I was only given 10 days to pay within in order to get the discounts. That was my discount period. In this case, right, I purchased my items as of February 1st. Okay, so I have until February 10 in order to meet my discount. But in this case, I missed it, and now I'm subject to pay on the 15th of February. So I just missed my discount period. So now I must pay the vendor in full for the total amount that I owe. And in this case, I owe $225, so that's what I'm going to write a check out for $225. Okay? Any questions in regards to recording purchase discounts using the gross method?
No.
Yes, Maidi.
Go ahead. Yes.
On the purchase discount, is it yes, purchase discounts, it is a profit or what?
It is not a profit. It is so in this case, right, because we're not looking at it in terms of sales, right, we're looking at it as in terms of an expense, right, us acquiring the asset in the first place. So in this case, you can treat it as a profit because you're selling it or the way that when you purchased it, it cost you significantly less. And of course, when you sell it, you're going to earn a profit off of it. But in this case, right, when we're looking at a purchase discount, in terms of just recording it as when we buy our inventory items, we're only looking at it as if it's just a mere expense to the company. Okay, so in this case, it's not a loss, okay, because, on the vendor side, they may have lost money because on their side, they sold something at a discounted price, where on our side, it's just, it doesn't really gain or hurt our company at all. Okay, so in this case, we're not looking at sales. We're looking at just obtaining the asset itself. Okay, so it's not technically, it's not a profit unless you're looking at it as your, when we get to sales, we'll talk about what the cost of goods sold is, and how we counter that against our inventory sales. Okay, so in this case, it's not a profit at all. Okay, any other questions?
Thank you.
No.
Okay, so let's actually talk about the net method, right? When we talked about net method, right, we remember it as you already discounted the items in the first place. So again, this time we're looking at the same scenario, but in this case, we're looking at the net method, right? So this time, February 1st, you purchase 100 coffee mugs at $1.25 each, with the freight costing $100. Okay, so terms are 5%, 10, net 30. So let's go ahead and record this transaction. So in this case, right, we're using the net method, meaning we're going to calculate the discount off immediately off of the actual purchase price. So in this case, right, we've already talked about how much that was, which was $6.25, right? So in this case, when we recognize how much we owe, okay, it's going to look exactly like this. We're going to recognize that when we purchase the items, it's going to be discounted automatically already, okay, as of the first day that you received it, okay? And of course, freight stays the same because you can't discount freight or sales tax, right? And again, we're going to owe it on an account. So therefore, in this grand total here, right, because the purchase price is discounted by $6.25 each, right? Therefore, I owe this company $218.75, where opposed to earlier, the gross method, right, when we record it as regular priced, right, it was $225. So in this case, I've already counted that I already took out the discount already, okay? So then, scenario number 1, it is now February 9, which you already know that you paid within the discount period, right? You're going to record it as if you paid for what you owe, which is for the $218.75, because you've already discounted the amount. You've already acknowledged that you already discounted the amount and that you paid for it, okay? Now, what happens if I accidentally missed my discount period and I recorded it as if I already took it out? Now, this is where you're going to have to create a contra account. So 2 contras, right? If a purchase expense increases with the debit, a contra account increases with the credit. What does a contra account do?
It debits it.
It goes through this process and it debits it again. So that's where we have to create a contra account and call it purchase discount loss. Because in this case, right, in the very beginning, I recognize that I already discounted my items. But because I paid and I missed the discount period, which can happen in businesses, right, because you're paying all of these expenses first. You're cutting the checks left and right, right? And in this case, right, we accidentally missed the discount period and end up paying on the 15th of February. So therefore, we need to recognize that we missed the discount period. So therefore, we need to recognize that we lost that discount by adding it back into $6.25 worth back into your purchase expense, okay, by creating the contra account, okay? So there we have it, right? In this case, right, because whatever you owed, right, in your books, you recorded that you owed significantly less. But because you missed the discount period, you need to enter in what the discount amount was for and determine that it was a loss because you missed it. And therefore, you need to write a check for the full amount plus the discount that you missed. So in this case, you're going to write a check that's going to be larger than what you owe for $225. Okay? Any questions here?
No.
Okay. All right, so chapter review. So we talked about periodic inventory, right? We talked about what inventory is in general, right? It is every single cost it takes to get the asset to the store. Okay. Okay. We talked about the two different tracking methods, right? Periodic and a perpetual inventory. Okay. So periodic, once again, is going to be where we recognize it as an expense, and that at the end of the accounting period is when we actually take a physical count. And in this case, right, periodic means every once in a while. And then again, perpetual is constantly, where you're updating your inventory every time you purchase and every time you sell. Okay, all right. And then we talked about the freight, right? Freight on board and COD, and how the process that it takes from getting it from the seller's store all the way to the midpoint to the buyer's store, who's responsible for paying the shipping. Okay. And of course, down below, this is an example of how you journalize a periodic inventory, right? We recognize purchase expense, freight expense, and forever, whatever, however you paid for it, okay? Then we talked about purchase discounts, where you have to have terms in order for you to go ahead and use one of the two methods, okay? Now, again, if a vendor does not offer you any discount, then you're safe to just go ahead and just record it the way it regularly using the gross method, okay? But in this case, if you are given terms, you do have two choices that you can record your discounts with, and that's the net method and the gross method. Now, in this case, I'm going to tell you this, because we are going to be looking at a small business and we're building it up from the very beginning, we're going to use the gross method throughout the rest of this class. But I do want to let you know that, yes, there are different methods that you can record your discount for if you would like, okay? All right, but in this case, I'm going to tell you that this class, we're going to be focusing more on the gross method because we are a small business, okay? All right, so now that we went over that, let's go ahead and go over the 5.1 periodic inventory purchase exercise. So this is where I'm going to have you guys, practice journalizing these transactions, okay? All right. Now, there are a couple ways that you can do it, right? You can do, right? So let's go ahead and practice using the gross method once again, right? In this case, there is no term, so you're obligated to do the gross method regardless. So let's practice journalizing these transactions and assume that all purchases were made with cash, okay? So first transaction of the day is going to be on April 5th. You purchase 1,000 units at $5 each, with the freight costing $100. Okay, so it's April 5th. So how should I journalize this?
With a purchase expense of
Okay.
5,000.
Good. Purchase expense of 5,000. Okay. What else?
And a freight expense of 100.
Good. Freight expense of 100. Okay. How did I pay for it?
With cash.
You paid with cash. Okay. For a grand total of
5,100.
5,100. Now, you do have the option here too. I believe I did not give you space to enter in that you purchased X amount of things. But again, since this is first time that we're doing this. Okay, I'll go ahead and include it. But if you are writing this down, you don't have space for it. You do have to expand your table a bit. But in this case, right, I purchased, right, 1,000 units at $1 each. Okay. Now, this is going to become relevant, especially when we dive into chapter 5.2, which is going to be coming up after the break. Okay. So there you go. Okay. So the next one is going to be on April 10. We purchased 750 units at $5.75 each, with the freight costing $75. So how am I going to journalize this one?
So that would be a purchase expense of 4,312
Okay.
and 5 cents. Oh no, if that's right.
Okay. Okay, so it's not 5 cents, it's 50 cents. Which
Oh, 50 cents. Yeah, my bad.
okay, so again, so $4,312.50 is going to go into the purchase expense. Okay, good. Now in this case, right, because we're using technology, I am also able to just copy and paste all this. Okay, so boom, right? So in this case, it was $4,312.50, right? How much was my freight?
75.
It was for $75. Okay, giving me a grand total paid in cash. What? How much was my grand total that I paid in cash?
It would be 4,387.50.
Good. All right. And of course, I can make my note here saying that I purchased 750 units at $5.75 each. Okay. Good. All right, April 20th, okay, I purchased 200 units at $6 each, with the freight costing me $20. How do I journalize that?
That would be a purchase expense of 12,000. I mean, 1,200.
Mm-hmm. Okay. So again, purchase expense for 1,200. What about my freight?
20.
It was $20, right? So therefore,
Mm-hmm.
in grand total, how much cash did I spend?
1,220.
Good. Once again, I'm going to make sure I put here that I purchased 200 units at $6 each. Okay. All right, last but not least, April 25th, okay, I purchased 500 units at $6.25 each, with the freight costing me $50. All right. How do I record that? April 25th, okay?
With a purchase expense of 3,125
$3,125.
and the freight 50,
Okay, $50.
which is 3,175.
Okay. And last but not least, my description will be that I purchased 500 units at $6.25 each. Okay. Good. All right. Number 2, what costs are included when making a purchase for inventory?
Wait, what is it? Wait, I actually don't get this one.
Okay, so in this case, right, I taught you what are all the costs that are included when you're making a purchase of inventory. Okay, so in this case, the question is asking you what costs are going to be included when you purchase your inventory.
Like sales tax?
Sales tax, okay, good. If you are charged sales tax, good.
Okay. Freight expenses,
Good. So freight charges, good.
shipping and handling costs, and storage fees, and price of products.
Mhm. Okay, good. So in this case, the definition is going to be all costs it takes to get the asset to the store. Okay. So which includes sales tax if you're being charged it, freight, shipping and handling, any storage fees, okay? You could come across foreign fees if you are producing or not producing, sorry, if you're purchasing items from overseas. Yes, that's included as well. Okay. All right. What are the 2 tracking methods of inventory?
Periodic and perpetual.
Good. Okay, I'm just going to put it like this. Okay. So what does net method mean?
Doing the discount before paying them.
Okay, good. Discount before let me reword that. Take the discount before you pay. Okay. Good. All right, so then here, number 5, using the gross method of periodic inventory, okay? If you made a purchase on April 5th, okay, of 1,000 toys at $5 each, right? With the freight costing you $100 on an account, okay? And the vendor decides to give you a 5% or terms of 5%, 15, net 30. Let's go ahead and journalize this transaction. So how would I journalize it using the gross method? Okay.
With a purchase expense of 5,000,
Mm-hmm.
and then with the freight cost of 100.
Okay. How did I
And
pay
then
for
with
this? Go ahead.
on account,
Mm-hmm.
so it'll be account payable
Okay.
of 5,100.
Okay. Good. All right. So then it says number 6 says continue with question number 5. You paid the vendor on April 15. Okay, so journalize this transaction or journalize the discount.
So that would be on time, I guess.
Yes,
Since
so in
we,
this case, right, when did I purchase the asset?
uh, uh, on April 5th.
Okay, and what was the terms?
Oh, 15 days. Okay, I
Mm-hmm.
didn't see the date on the three.
Okay. So in this case, right, the date here for this is going to be April 15. So did I make the discount or did I miss the discount?
You were on time.
You were on time. Good, right? You paid within 10 days. So therefore, yes. So how am I going to record this payment?
Mm, with account payable of the. I already forgot the number. Can I look back up there?
There you go.
Of 5,100.
Okay. So in this case, right, we're decreasing our liability because we're paying it off. So therefore, my accounts payable is going to be debited because I no longer owe this vendor anymore, right? I'm paying off what I owe. So in this case, I'm decreasing my liability. Now in this case, right, my liability is for $5,100. Now, in this case, I met the discount period. So what should I am I actually going to be paying for the full 5,100?
No.
No, you're not because you made the discount period. So what account am I going to use to reflect that?
With purchases discount.
Yes, excellent. With a purchase discount. So here's my contra account for the purchase discount. Right? It's a contra account. So in this case, right, it's going to be reflected as a credit. Okay? And then, of course, I'm also going to be writing a check out because you should be writing a check out for this. Okay? Now, in this case, how much is my discount for and what amount am I going to be taking out? So let's talk about how much is my discount for? What percent?
5%.
It is 5%.
Yes.
Now, how much am I going to be taking out from my actual purchase discount? What is the total amount of discount I'm going to be taking out?
125.
Why 100?
125.
125. How did you get that number?
Yes. 5 multiply 51.
Say that again?
5 multiply 51.
Okay. Okay, so in this case, right, that is incorrect because you included the freight. You said 500,000. Wait, you said 5,100 times 5%, right? Gave you
Yes.
255?
125.
125. Okay, so that's not right there either.
Not right.
No.
Would it be 250?
It would be 250 because in this case, right? Can we take a discount off of the freight? Can we
No.
discount freight? No, you can't. Just like I talked about this earlier, right? Can you go to UPS or FedEx and say I want a discount off of my items that I'm shipping out? No, you can't because either way, when you pay for shipping, it's already either at standard rate or it's based on how big the size of the box is and how heavy it is, right? It's standardized rate. You can't discount that. So in this case, that applies to this as well. You paid for shipping to get the items to your store, right? You paid for that. All right? So in this case, right, can I discount that item? No, because you can't tell the vendor, hey, if I pay for this, give me a discount on the freight. No, they're going to laugh at you. So in this case, the only thing that you can discount is just their actual purchase price. So in this case, the actual purchase price is what? It's $5,000, right? Because you purchased 1,000 toys at $5 each. So your actual purchase price is going to be $5,000. You can only discount 5% off of the $5,000, which gives you $250. Okay? Now, in this case, how much should I be writing my check out for?
Would it be 4,850?
Yes, because in this case, right, I'm taking the $250 discount. I'm taking that out from the actual amount that I owe. So in this case, right, if you think of it the other way, where you're talking about your debits matching your total credits, then that would also be a factor of how you could figure that number out. But in this case, right, if I take my 5,100, subtract the $250 out, I should owe or pay $4,850. Okay. Question number 7. Well, let me push this down so we can see it better. Okay, so question number 7 says that using the information in question number 5, journalize the purchase using the net method. Okay. So same idea in question number 5, but this time we're going to use the net method to record the transaction. So here's question number 5, that you purchased 1,000 toys on April 5th, okay, at $5 each, with the freight costing you $100. Terms were 5%, 15, net 30. Okay, so how am I going to journalize it if I'm using the net method? So April 5th.
With a purchase expense of 5,000.
Okay, so this is the net method.
Oh, yeah.
So 5,000 wouldn't be in this spot here.
Oh wait, where am I looking at? Um,
4,000.
oh, okay.
4,000.
Yes.
Four,
750.
4,750, because in this case, right, we're using the net method where we're taking the discount immediately. So in this case, we're going to take 5,000. We're going to take the discount of 5% out from it immediately. So that should leave us $4,750, right? Because the discount was $250. All right. What else am I going to include here?
The freight expense.
Freight expense for how much?
100.
For one.
Oh, wait. Yeah, 100.
Okay. So
Um,
then if I owed it on an account, so accounts payable, how much do I actually owe now?
4,850.
Good. All right. So that's the difference between the gross and the net method, right? The net method, I take the discount immediately and I record it as if I'm buying the items discounted. Okay. Good. Last but not least, what does terms mean if 2% 10 net 20?
You get a 2% discount if you pay within 10 days. If not, you'll pay full. Or did I say that wrong?
If not, pay in full in how many days?
20.
20 days. Good. Excellent. Okay. All right. Any questions in regards to chapter 5.1?